You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for Volatility Views, our weekly sojourn into all things volatility. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, soon-to-be-expanding yet again, Options Insider Radio Network. And, of course, the mecca, the mothership, the flagship for all things Options Insider content, whether it's written or on the audio side. Well, of course, theoptionsinsider.com. You can get it all there. You can spend your whole day there. We wouldn't hold it against you if you wanted to just keep that tab open all day and stream some shows, click on some articles. We would not hold it against you at all. But if you just want to go mainline the radio, you can always just click on the Insider Radio Network tab, top left corner of the page, or indeed the call out there on the right side of the page. And you can use either one to stream, download until your heart's content. It's also right there, smack dab in the middle of the homepage there, too, that player right there with the most recent episode of whatever program is the latest on the network. Our news show, maybe this show, maybe OB, who knows? Whatever is the most recent update and upload, you can get that right there as well. So if you want to just come in, surf in, and see what's playing today on the network, you can do that too. And of course, we're also available via your favorite platforms, iTunes, TuneIn, Stitcher, so on and so forth. Whenever they flip that switch over there on the Google Podcast, I believe some people have that activated. I think they're rolling it out in beta now. So we should be active and live there. So if you have it, let us know, because we don't even have it yet, even though we've been uploaded to the store and everything's been approved and we're ready to go. We're just ready for Google at this point. So Google, a little late to the podcast party, but better late than never, so you can get us there. And of course, as always, we welcome you guys over there in the MixLR chat room if you want to stream live every Friday, noon Central, 1 p.m. Eastern, for good old Vol Views. Join us, ask some questions, send some comments, all that fun stuff. Of course, you can always just stream live and send your comments via the usual platforms as well if you don't want to mess around with an account. I can certainly understand that as well. And joining me on the old program today, starting off, he hasn't been on in a few weeks, so we'll give him pride of place, though he's not beaming in from his palatial corner office. He's more now beaming in from his corner home office / broom closet. He is Mr. Russell Rhodes, a senior instructor over there at the CBOE Options Institute. Mr. Rhodes, welcome back, even though, indeed, from the broom closet, not from the corner office.
I'm in the corner of the kitchen right now, and I'm surrounded by dogs. who are hopefully going to sleep very quietly as we go through the next hour or so.
So you're saying volatility, a good sleep aid for dogs, is what you're saying?
Yeah, most definitely. Anytime I start talking about VIX or anything like that, it puts everybody to sleep in my household.
Well, there you go. It must have been fun bedtime stories.
I don't know if that's true. I've seen your daughters write a P&L chart.
Oh, yeah. That's nothing better than going to a restaurant that has a paper tablecloth and some crayons, and we start practicing our iron condors and iron butterflies on the weekends.
Interesting.
I love it when I can leave you speaceless. That's pretty good.
That is a rare feat. And someone else who is often, or should say infrequently speechless, easy for me to say today, is the rock lobster himself. Actually, that would be his cohort. He is the Greasy Meatball, Mr. Mark Sebastian. From hither and yon, Mr. Greasy Meatball, I know you're not sitting next to me in the studio today, so where are you beaming in from today?
I was planning on it, but I just got held up here in my home office, not the home office, but my actual home office. In beautiful the western suburbs of Chicago. And, that's not a lot you can do about it.
And I turned around and I noticed that the adult beverages section of the studio here was still remarkably full. And I was like, oh, that's right, Mark isn't here. That's why we have so many. Our beverage selection is still so hearty and hale. So there you go. Maybe next week we'll have everybody together in the studio once we get all things sorted out. I'm happy to be back from my traveling all across the hemisphere down to Puerto Rico and back. Some interesting things going on there. But first, let's get into what was interesting in the world of volatility, because it's time for our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review, the portion of the show where we break down the week that was from a volatility trading and analysis, and sometimes from a research perspective as well. We are recording this here and streaming live, of course, on Friday, April 8th, right around the middle of the session here in noon Central here, 1 p.m. Eastern. So part of the way through the day or so. And as the day is unfolding, it's pretty much mildly bullish, you could say, on most of the major indices. The S&P and the Dow up nearly half a percentage point on the day. The tech-heavy NASDAQ not feeling the love, unched to slightly off on the day, and the VIX cash doing a nice exhale going into the weekend here right around the 15.5 level or so, after having seen a bit of a run up into the mid-teens earlier this week. So a lot of stuff to get to this week, a lot of interesting things, but I think we'll start in the corner office / broom closet, because Mr. Rhodes has been gallivanting quite a bit and hasn't had a chance to be on the program of late. So Russell, we'll start with you. What's been catching your eye this week, and maybe even last week if you want to go back a little bit too, from a volatility perspective?
I'll tell you, the small cap versus the large cap volatility. RVX, especially at the end of last week, was topping. It was hitting the highest levels we'd seen in some time, and this was despite all the markets kind of working their way higher. It just indicates to me that maybe globally people aren't as concerned, but domestically there's a lot of concern with respect to what's going to happen to the U.S. economy for the rest of this year. And then I did a little bit of digging beyond that, and I looked at in the first quarter, what had done well and what had not done well. And if you take large cap growth and large cap value and small cap growth and small cap value, of those four sectors, the only one that was actually down in the first quarter was small cap growth, which you really can attribute to what people think about the U.S. economy. And despite broad-based indexes being pretty close to unchanged, the Russell 2000 small cap growth was down over 4.5% in the first quarter. And I think those are the kind of things that when we look back, if we do enter a recession, are going to be kind of like a precursor to that, or an early signal that the U.S. economy is not doing all that well.
Yeah, last episode, even though you weren't on, I channeled you a little bit through one of your blog posts about a setup and a bit of a divergence looming there in the Russell versus VIX land. How is that setup shaping up? And did you ever get you said one of your favorite trades was shaping up. Did you ever get it off?
I didn't, because I was on vacation, and then I was actually spending quality time with the people over at FTSE Russell in New York earlier this week. I didn't take any action on that, but I got a lot of confirmation talking to a couple of strategists and some other people in New York that it really does look like the risk levels for small caps a lot higher than the risk level for large cap. And I didn't get any disagreement with respect to, what that bodes for the U.S. economy. It's very difficult to get anybody to be a cheerleader for the U.S. economy, regardless of what sort of rebound we got out of the stock market from mid-February into the end of the first quarter.
Yeah, it is entering that weird period. We just came out of the earnings fracas, and we are once again about to head into it yet again. So that might be perhaps a bit of a bellwether for how we're looking going forward. But you're right, not a lot of optimism there going forward with the economy. And when we're looking for optimism, we don't turn to this fellow, but we'll turn to him nonetheless. Mr. Greasy Meatball, what in your, shall we say, skeptical view was catching your eye this week from a volatility trading perspective?
We had a real vol squeeze yesterday, which is Thursday, and really back-to-back days where the futures performance of April has been just astounding. There was one point yesterday where I was looking and the cash index was up, I want to say $2.30, $2.40, and the VIX future that expired not next week, which maybe you'd expect to be moving close to lockstep with the index, was up about 85% of the cash index move. It was astounding the way that happened, and I was kind of shocked, to be honest, at what happened. Then we saw just an absolute spike, and then just a total dump job. So I think yesterday we watched the market obviously sell off, but a real short squeeze in multiple people that were short April, front month futures, maybe a little too aggressively. And, that was kind of interesting to watch.
Yeah, well, it has been interesting watching the vol flow and the vol kind of push and pull going on out there over the course of the week. Things, you're right, getting perhaps running away a wee bit, and now today taking a step back off of that proverbial cliff. And before we keep going off that cliff ourselves, I want to roll on into, I know, one of your favorite segments, Mark, and certainly one of mine as well. It's time that we've been deprived for a couple of weeks, so we need to get it back going again. It's time for Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
All right, Russell, you know the drill by now. Go ahead and regale our listeners with all things weekly VIX options, sir. Have at it. The floor is yours.
Oh my gosh, I missed that so.
By the way, have your family heard your theme music yet?
Has who?
Has your family heard your theme music yet?
Oh yeah, they've heard it, and they have asked to be disassociated with that.
As right they should.
Yeah. So, just looking at the weeklies, there's somebody that came in back in early March, and this may be throwing in the towel on being short volatility. Somebody came in and did a really good trade back on March 11th. They bought about 6,000 of the April 13th next week's 16 puts. They paid 29 cents for it, and it looks like they may have gotten out of that trade today at 82 cents. So, I think we've talked about, like you mentioned, I hadn't been here in a couple of weeks, but it seemed to continuously, when we would talk about the weeklies, we would talk about speculative short activity for VIX using, different weekly expirations. We had the 16 puts, the 15 puts, we actually, which seem to have long positions on them, the ones that expire next week. We actually very recently, when VIX back on the 5th, which day of the week was that? I'm still trying to get myself reoriented after travel. On Tuesday, somebody actually came in when they had an opportunity, and it looks like they sold about 6,000 of the 14 puts at 10 cents. It looks like they've gotten out of that, that they were using that as an opportunity to, maybe take in some premium, since they have, because they keep using the same size of around 6,000 contracts. I'm going to assume it's the same guy. But they seem to be taking advantage of VIX being at relatively low levels back on Tuesday, and the ability to sell some of the 14 puts for 10 cents. Now they're a nickel offer, and the open interest hasn't changed, so I assume they're holding on to that. But it looks like they're getting out of one of their long put positions with a nice, almost more than a double in profit on that one. Looking out to April 27th, there's a short call spread about the same size. They're short the 17 calls and long the 25 calls. They did it at $1.58 credit, and it hasn't been touched since it was put on last week. And somebody's long about the same number of the 16 puts, going back to that 6,000 number, and they paid 44 cents for those on March 28th. So I don't know, it looks like there's some profit taking, but they're not throwing in the towel on low volatility yet.
Always nice to see some put love going up out there in VIX land. We don't get to tell that story very often, so it's kind of fun when we can do just that. Looking at the mothership VIX story throughout this week, it was a bit of an evolving tale. It started off fairly light this week, with volume on Monday being about around 250,000 contracts, which for any other product would be just kicking it through the moon. But in VIX land, it's not even half of the ADV out there in any given day, hovering right around 650 or so right now out there from an ADV perspective. Tuesday also pretty light, right around 400,000. Wednesday creeping closer to the ADV, about 573, and then Thursday finally getting close, over 600,000. As we stand today, right about middle of the session here on Friday, looks like it's going to be yet another light day out there in VIX land, with only about 176,000 contracts having gone up so far today. There might be a flurry later on today. Who knows? But for now, at least, doesn't look like we're on pace to be breaking any records today. And speaking of today's volume, it seems like it was pretty much the only real size trade going up today of any interest. Was someone had to have some June 23s and had to have them to the tune of about 40,000 contracts gobbling up for prices around $1.68 or so out there. That's pretty much the one size trade of the day. Going back a little bit earlier this week for some other interesting nuggets. Looks like we saw a bit of on Thursday yesterday, a bit of an April-May roll going up. It was May 22 roll going up. Looks like about nearly 10,000 times, closing out on actually a buy in the back on the April side, and then shorting, so short roll out into May on the 22 strike. Doing that looks like for about 90 cents, a little bit more size on the May strike, about 2,000 contracts more, so nearly 12,000 going up over there. Also looks like some funky put love, as Russell was alluding to earlier, though not in the weeklies. This time out in July, started off, looks like a bullish risk reversal. All these trades going up in similar size, which is kind of interesting, even though they went out scattered throughout the day, sometimes multiple hours apart. We started off here with looks like an 1825 risk reversal, bullish going up out there in July on Thursday, about 10,000 times. Then a few hours later, we saw another 10,000 lot, this time going up. Looks like the 14-15 spread, or perhaps a stupid, going up out there in April as well on these different strikes. And then later in the day, we saw paper selling just about nearly 10,000, 9,500 of the 1925 vertical. Not doing that on a ratio, and we talked before about selling one, buying two, and how that being a fairly effective strategy in a variety of different scenarios out there, depending on the term structure and what's going on out there, obviously in the VIX futures land. But still, this one, just doing it one-to-one, 9,500 times. And speaking of funky upside, I don't know, maybe you saw this one, Mark, going up on Wednesday. It looks like it was the May 1924 Looks like it was a 1x2 short, but it looks like it was a stupid. Looks like it was paper selling about nearly 25,000 of the 19 calls in May, and then coming in and also blasting out right on the bid about nearly 50,000 of the May 24 calls. So doing it 1x2, but both stupid side. So that seems like a bit of a head scratcher. And of course, earlier this week, we did have some a continuation of, aside from that 1x2 stupid, we did have a bit of a continuation, which I want to dig into that one a little bit more to make sure that is indeed what happened up there. And then, of course, May 25s, people with paper gobbling up about 38,000 of them, 65 cents, as well as the May 22s going up a couple of different times, paper gobbling up, lifting offers. It's like a total about 50,000 contracts for prices around $1.05 or $1.10. A lot of interesting stuff. Funky ratio, looks like a funky ratio. Short puts, short in the money puts. The April 17 puts short versus 13,500 times versus the April 16 combo by call sell put out there about 6,700 times, doing that on a bit of a ratio out there as well on Tuesday. So we saw our fair share of funkiness. And speaking of funkiness, Mark, I know you saw this one. Even moving beyond the mothership VIX options for a second, we talked earlier in the week on the option block, but about this this funky 8-way. I suppose you can call it an iron condor. Actually, it'd be more of an iron fly, but it's not a swap. It's a stupid, a time iron fly stupid. This one catch your eye, Mark, out there in VXZ?
Yeah, it was interesting. They actually did. It was a stupid. They did both. It was odd.
I'll walk listeners through the strike so they can get an exact take on this one. Maybe Russell, this one caught your eye too because it's just so kind of weird. The one question we kept asking ourselves on the option block as we were reviewing this was just why. It was the June 9, 11, 13 iron fly going up 2,000 times versus the SEP. Same strikes, 9, 11, 13. Paper buying the wings, selling the guts. Doing it again for size and doing it selling on both. So not like you're swapping, and there was no appreciable open interest in either of these strikes, so there was no rolling going on. It was just straight up, I want to sell myself some iron flies out here in VXZ. If you're not familiar with VXZ, by the way, listeners, that is the mid-duration, midterm VIX futures ETN, so it tries to approximate at least that kind of middle of the curve, the 4 to 7 month duration. And our friend here saying he just wants to short it all. So that one certainly sounds like it resonated with you, Mark.
Yeah, it did. There were a few. I do think that 1x2 was facilitated, and that's why it came up those prices. I think that would make more sense. I think somebody paid a broker a lot of money to do it at prices they wanted, because nobody wanted that. The crowd really wanted, from what I hear, it, and that got traded before it hit the floor. And there were some unhappy people around that VXZ trade.
I could see how those prices. I could certainly see why people would be unhappy. Yeah, on the surface of it, a 1x2 stupid makes a heck of a lot of no sense. So I figured the prices had to be wonky there or something like that.
There were some other trades. There was a customer in, actually. I thought this was kind of interesting. He wanted to buy one and sell two of the April 1821 1x2 call spread, so expiring April 20, and he wanted to collect 2 cents. And I think it ended up trading a penny yesterday on that panic. So, guy thinking, hey, maybe we can get a little push toward 18 over here for the next couple of days or weeks in VIX. And there's some definite paper flow was extremely one directional, not the band, the way the paper was flowing when VIX was in the 13s and on Mondays and Tuesdays. Now we're watching a lot of two-way paper flow, both ways. The call sellers, call buyers. Just saw somebody buy the April. They just paid 8 cents for the April 30 calls tied to stock. I don't know why you do that, but somebody did.
Yeah, it's been an interesting week. Even though the volume wasn't high, there were definitely some nuggets to cherry pick out there in terms of just kind of head scratchers out there in VIX and VIX related land. I'm glad you had some more data on that 1x2 because that one was not sitting right with me in any way, shape, or form. Clearly, there was more afoot there. Sometimes when they facilitate these things, you're right. They put them up at funky prices that leave everyone else after the fact kind of scratching their head saying, what the hell did they actually do here? So that sounds a little bit more par for the course. Moving on to what else has been lighting it up out here in the realm of all things VIX options, looking at the top 10 hot strikes for this week. Number one, yet again, the April 25s with about 332,000 contracts lighting it up. Still the king of the hill there. Number two, about 272,000 open of the June 23. So getting a little bit farther out, getting a little bit farther down the strike chain. Kind of interesting there. Number three, the ever optimistic May 30s, about 260 or close to 1,000 contracts open there, followed by the slightly less optimistic April 30s with about 245,000 contracts open there. Number five, the May 25s, about 212,000 contracts. Then we drop down a bit to number six, the May 22s, 182,000 contracts. And then number seven, the April 28th, so getting back up on the old strike chain again, about 166,000 contracts open there. Number eight, the April 27s, 156,000 contracts. Number nine, the April 20s, 146. And wrapping it up in number 10, finally our first put on the list, the April 15 puts, 138,000 contracts open there. Total, grand spanking total of about 7.5 million contracts outstanding, at about 5.7 on the calls and a little over 1.7 open on the puts. So a lot of interesting stuff. Before we move on from VIX options and related products land, any other activity catching your eye this week? Could be VIX options, could be VXZ, could be something else equally crazy and esoteric. Russell or Mark, the floor is yours now. Have at it, sirs.
I didn't see a lot of interesting things.
Yeah, I think we kind of
I was just pausing because Mark always jumps in there real quick.
Yeah.
But this VXZ trade, it had me digging around a little bit, and I took a look at if we're in a choppy market environment in the past, VXZ tends to stick within a range. So if you're thinking the kind of goofiness that we've seen this past week is going to keep up, that might be a motivation behind this trade.
Yeah, certainly seems to be the way he's leaning. I can't see any other really or any other real interpretation of that makes a heck of a lot of sense. If you listen to any of our programs, I take a dim view of spreading your position out over time like that, unless you have a really good reason for it. This one, there could be some reasoning behind the. It's just a fairly light name. There's not a lot of OI in any of these strikes, and maybe you got to spread the love around to get a little bit. Still going all the way from July to Sep. That's a bit of a head scratcher. The whole thing's a bit of a head scratcher. Let us know, listeners, what you think about that VXZ trade. Maybe you guys trade it. Maybe you don't. Maybe you have some interesting other thoughts behind that one. Let us know. We'd love to hear from you guys. Meanwhile, let's keep on rolling into some other products that have been lighting it up from a volatility and action, a call it what you will perspective. It's been kind of our on again, off again love affair with all things crude oil here on the program these days. When we talked about it last week, it seems like, or at least it seemed like at the time, the bears were back and forth. The puts were where all the love was all times last week. And now pulling it up here as we're pulling up good old WTI here for some from skew analysis. And it seems like that narrative still pretty much in the case, with the exception, yank out the ridiculously front term there, where it seems like a bit of call love kicking off over there. That's not surprising given some of the near-term price action we've seen out in WTI of late. But still, it seems like the long-term consensus is towards the put side, even though the calls seem like they're getting a wee bit more love this week than they were just 1 week ago. Shows you yet again how somewhat variable this WTI skew is. It's nowhere near as as permeable as, let's say, the gold stuff is, which flips call side, put side, smile pretty much every other week. Oil's been pretty much in the put bid realm for the better part of the last year, but there has been a little bit of nuance here or there, and we're seeing that going up this week as well out there in the pure crude vol land, OIV, OVX hovering around a 46 level or so, mid to high 40s. Again, well off the highs that hit not that long ago, just about 2 months ago, back in mid-February, where they flirted ever so briefly with the 80 handle. So we're seeing a bit of a vol retreat. We're seeing some interest going back into pretty much focusing back on the put wing, even though there is a little bit of call love now. So it seems like we're kind of back in that narrative we had way back 3 or 4 months ago when there wasn't a lot of vol and there wasn't a lot of upside love out here in crude. Perhaps this is once again the regime we find ourselves in going forward. Mr. Greasy Meatball, perhaps we'll start with you. Anything catching your eye? I know you also like to look at USO, so anything catching your eye out there in USO land as well?
Commodity vol's kind of backed off. I think gold vol's starting to look attractive, but oil vol itself I don't think is overly crazy. To Russell's point, I've been watching Rut. Rut vol is still juicy. And actually, there's a little bit of juice in. If you look at the VXN NASDAQ 100 vol, there's some juice there. We're vol's down today. NDX vol's up. So there is some. VIX is clearly the kind of bastard stepbrother of high volatility among the vol indexes.
Well, I can tell you from experience that when the economy starts to turn, the stocks that get hit first are usually tech stocks. So that kind of jives along with the whole RVX being relatively high as well. That's if you think the economy is going to go in the tank this year, you want to be short, semiconductor equipment, stocks like that. And those are the ones that, contribute to the implied volatility on the NASDAQ. The other thing is when we do go into earnings season, VIX doesn't really get impacted. RUT or RVX definitely doesn't get impacted, but we've got some big stocks and you'll start to see that influence VXN. So when you start to see, earnings approach, which next week isn't it, but the following week is most definitely it, that can have some influence on VXN as well.
Moving on to the other commodity that we like to watch. It's been exhibiting a wee bit of vol over the past year. That is, of course, the shiny stuff, good old gold, looking out at the big mothership gold options. And they're looking pretty much still firmly in smiley camp, even though it seems like the call's getting a little bit more love this week than they were last week. Still nowhere near the extremes of skew love that they were receiving. About middle of February, so about 2 months ago, when it seems like every investment bank and their mother was out there writing, saying you needed to pick yourselves up some 1x2s out there in good old GLD and related products, because that call skew was just so rich these days. Not quite the same beast. Pulling up here the same data over here on GLD, courtesy of our friends over there at Trade Alert. I see Mr. Schwartz floating around in the chat room there. So since he's floating around, we'll pull up some stats on his and looking again skew numbers. I always like looking at skew numbers over here in the realm of Trade Alert, and that skew not as high as in the 10th percentile again, and that should indicate to you that the call is still a little bit rich, but not perhaps as rich as they were. Usually skew quoted with the put wing over in most of these names like GLD listeners. So when you see low numbers like that, that indicates the puts are cheap or the calls are pricey or perhaps a wee bit of both. And 10th percentile for the year out here in the 30-day skew out there in good old gold. Mark or Russell, anything catching your eye out there in the shiny stuff?
I was kind of shocked at how, you said it's smiley looking, but man, to the upside, you go out a little bit and the implied vol is, the near term implied vol for like the April 15th and April 22nd weeklies on, or I guess April 15th is not a weekly, but the April 22nd, and even the April 29th options, it's looking like somebody thinks we're moving to the upside or somebody's worried about the upside in gold.
Yeah, like I said, it is richer than it was last week, and I don't have the skew up here as terms of charts for GLD, but the big gold option showing again more richness to than there was last week, but still fairly, shall we say, equal love around most of the sides. I don't have. Let me pull up a GVZ via our friends over there at CBOE Live Vol, still hovering right around about the 19 handle or so that it was last week, right around 1875 or so. Of course, that one also peaking back about 2 months ago, back in mid-February, right around the 28 level, flirting with 30. So we're again right about half of where we were back just a few months ago. So it does seem like commodity vol, at least for the near term, has peaked a wee bit. And then going forward, we'll see if perhaps something can shake it up, maybe some additional systemic shocks out of China or some other for gold, of course, looking in the Fed space, and we'll see if some of that can inject some life. I know last year when we got down, I believe it was into the 12 to 14 range in the implied out there in gold options, which I believe was about early July of last year, is when people started noticing, including our buddies over there at the CME, who put together an interesting research paper about saying, hey, these are near record lows for implied out here in gold. Maybe something is afoot. And sure enough, about a week later, mid-July, is when gold went off to the races and vol went off to the races. And what an interesting saga it has been ever since. Who knows, if we keep drifting down here in gold vol, maybe perhaps that will portend interesting things to come. Speaking of interesting things to come, hopefully your questions will be interesting, because it's time for the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility voicemail. Of course, the portion of the program where you guys get to ask your questions and comments. Russell, really quickly last week, Andrew and I hit on a question we had from a listener. They wanted to know how the recent streak of backwardation, which ended back in February, how that stacked up to the recent run above 20 out there in VIX cash land. So I shamelessly pulled a few of your data points from your blog. I think you wrote a few weeks ago, doing that exact same analysis, breaking down some charts of where the backwardation skew, where that period, how long that ranked. I believe it was number 4 historically. So since I shamelessly pulled your data, of which I credited you, I'll give you a chance if you want to chime in on any of that before we get into what may perhaps be the most epic listener question we've ever received on our network. Anything to add there, sir?
No, nothing in particular since the blog came out. We haven't really gone back into or created another streak. We know that when we've had these long streaks and we come out, it's usually fairly bullish, and we did get a nice bounce from the equity markets. So there's not a whole lot to add, because that was a little bit in the past, and I think the market did what you would expect it to do when we had been in backwardation for a long time and then come out of it.
All right, then let's move on then to perhaps, like I said, start reading this epic treatise of a question. We'll start rolling, and then we'll see if we can get him on as we're doing this. All right, this one comes from Jeremy. Russell, get ready for this one. He writes, I'm going to have to skip a lot of this. We'll see. Just for interest of time for reading. Hi, guys. The show is a great resource. Taught me a lot throughout the years. I was listening to a recent show. He actually was referring to another episode of a different program, Uncovered Calls and the IRA options debate. I wanted to write in regarding the discussion on dynamic hedging of a short option position. Let me introduce myself and provide some context. He gives his name. He's in the final year of PhD. He worked at NASA Ames Research Center. His PhD focuses on modeling, simulation, and analysis of stochastic processes and the application of optimization algorithms to the air traffic control system, of all things. He even so kind enough to send us a link to verify him on LinkedIn. So I do love the thoroughness of our listeners out there. He goes on to write, in addition to his PhD work, I'm starting a fund with some other academics, specializes in delta neutral trade. That's why I wanted to move it to this show. I thought it was more appropriate for this program. He goes on to write and has developed 2 tools to execute volatility premium harvesting strategies. I provide a short description of the tools below. In particular, the second tool is directly related to dynamic hedging of a short option position and the discussion on the previous program. Skip ahead a little bit here. He says our stochastic volatility tool estimates volatility using high-frequency data such that the microstructure noise is directly accounted for. He uses the Bayesian algorithm to provide estimates of volatility where estimates are consistent across all sampling timescales. Let's see. Provides sampling of arbitrarily large volatility paths throughout time. And then the number 2 tool, the stochastic optimal control tool for hedging a short option position or a short combo. After the option sold, the risk can be controlled by efficient delta hedging. This can be done by calculating the optimal price boundaries to trigger a hedge in the underlying asset. Moreover, these boundaries are informed by the dynamics of the volatility as calculated from our stochastic volatility tool. The strategy that the Greasy Meatball provided on the show, Mark was at the time talking about hedging, dynamically hedging some short positions on the episode he's referring to. He goes on to write here, the strategy the Greasy Meatball provided on the show to hedge the short option at the close of every trading day is a good start. The problem with that strategy is that this approach is a suboptimal timing mechanism. Many days you will hedge at the close and you don't need to, leading to increased transaction costs. Instead, this problem should be formulated as an optimization problem that we can then solve to provide the best strategy. A little background on the academic literature, deal world, Black-Scholes model, et cetera, et cetera. I'm not being rude. I just this message is pretty lengthy, listeners. Hence, it is impossible to perfectly replicate the option in this setting because there are transaction costs. That's true. How to optimize this with respect to risk and uncertainty has been a topic of research for years. Many strategies. I will briefly present one. Nothing brief about this one, even though we do love the question. He attaches a paper as well. The attached paper was published in 2009, Journal of Economics, Dynamics, and Control. The approach, of hedging, the problem of trying to tackle the problem of option hedging in the presence of proportional transaction costs and trying to formulate that as a singular stochastic control problem. The author's approach is based on a minimization of Black-Scholes type measure, a pathwise risk defined in terms of market delta, subject to an upper bound on the hedging cost. The approach can be applied to solve the problem, maximizing utility. I was joking about this on another program this week, Russell. The notion of economic utility, one of my more enjoyable and laughable economic notions. He goes on to finish up here. The main idea of the attached paper is to calculate boundaries that trigger a hedge in the stock. Moreover, the number of shares that should be held when we reach the boundary is also calculated. Attached to this email, also attached a screenshot for our edification here, is a screenshot from the paper that illustrates these price boundaries. Without getting into too many details, top figure indicates price boundaries for the option open with 1 unit of time left. It's a pretty extensive graph here he included as well. He goes on to concede this email is most likely too long, but I would love to continue this discussion. He wants to talk effectively here, Russell, to summarize this very, very detailed email that he wants to talk about dynamic hedging and the intricacies therein. 1 second, we're having some more issues here. On the back end, trying to get Mark back, listeners, as I'm doing this. And that effectively here, Russell, this is kind of an issue that market makers were wrestling with early on, and even still to this day. If you have any sort of long premium positions in particular, this is a subject of debate. Is effectively to summarize all of this, when to work your gamma hedges in the most effective proportion, delta weighting them as they clearly are leaning on doing that here. I've seen a lot of guys utilize that approach as well. But this is an area, as we've seen here, this is an area where it becomes as much voodoo as it is science in terms of what is going on, how do you work an effective gamma scalp effectively. And it's one of the reasons, too, when we first started the show, we started exploring alternatives to the traditional dynamically hedged delta neutral position for capturing volatility, because it's not a viable approach for such a huge percentage of the marketplace, unless you have the resources to do a lot of these things we're just talking about here, which is outside the scope of a lot of retail. It just is simply is too difficult. So that said, Mr. Russell, I've been talking for a while, so I'm going to let you dive in on this one. What are your thoughts, if anything, if you can encapsulate them on this epic treatise of an email from Jeremy?
I've got a very short answer to it, and it really comes down to the art of trading component of being a market maker. You can fully quantify things, on a look back basis, but sometimes, that at times you're better off, not fully hedging yourself overnight, and sometimes you're better off rebalancing during the day. But what it really comes down to is the guys that are market makers in their individual markets have been watching them for decades, and they've got a real good feel for how the underlying market behaves, and that's kind of what separates the good market makers from the great market makers, are the ones that have a really good feel for their underlying market, and it kind of trumps the computers. They say that the quantitative stuff is great, 95-99% of the time, but that 5 to 1% of the time that you want people in there, it really does pay off. And I think that's because all he's doing is really talking about how market makers go about trying to stay as neutral as possible and benefit from their positions in options. So it's a much shorter answer to a very long question, which I read and then listened to you fill in as well. So I wish I had more to add to it than that. One of the things that Bittman would always throw in there was 90% of the stuff is quantitative, but then there's this 10% art of trading that you always want to add to things, and that's what that's really what adds to the quantitative part of what he's talking about.
Russell, I couldn't agree more. I mean,
Yay.
Well, it's not like a quantitative model can recognize a short squeeze and that you should let your long deltas run, or that the market is in a panic and vol's rallying and now is not the time to be buying your delta, even though you see even though you see everything drop. So it's pretty nutty.
Yeah, Mark, I don't know about you, but for me, the challenge of working effective gamma scalps over time was one of the things that really over time seemed to break me of any interest in or belief in the efficacy of technical analysis, because I saw every single approach you could possibly imagine tried to be applied to this exact problem, which is when to work your effective gamma scalps. That's the lion's share of the problem. If you got any long premium on, you need to be gamma scalping aggressively to survive the day and make back your money till you can hopefully take off that position. And I tried every way imaginable to make that work, and nothing really. And part of that could be the extremely short-term nature of the problem. This is what you're talking intraday. Most technical analysis, I think, is probably based on a little bit longer-term analysis than that. So that's part of the problem. But still, for me, that's kind of, if anything, turned me into a long-term cynic and definitely a questioner in technical analysis. It was the ongoing problem of gamma scalping. Did it have the same impact on you?
Yeah, I mean, it's a mess. I mean, there's nothing worse than, especially with short gamma, when you cover your gamma, then it just moves all the way back down, and then you have to uncover it. But where the art is really making a determination on the open or on the close, kind of where things are moving, and when to allow your deltas to run. I mean, it's really just about when to let your deltas run a little bit. I never used any technical analysis on it. It was more just, oh, this sucker's got some momentum, I'm going to dial it back. Maybe it was just an approach of hedging some deltas, but not all of them, as things moved around. And so, it really was kind of a volatility based. And one of the things I always liked was that, if I looked at my gamma when vol was kind of low enough, volatility kind of helped me determine how often to scalp, because when volatility was dropping and everything stunk, I would be scalping around more. You end up scalping more aggressively because you have more gamma. And so that's I don't know. Maybe that's a rambling answer to the exact same thing. 95% of the time I had very strict rules, but there were some periods of time where I went, wow, I better get out of the way, or wow, I better get more aggressive on this in order to get anything out of this.
Yeah, you're right. Those are the kind of few scenarios, kind of like the analogy, I hate to use it, but the analogy to the casino, where sometimes when you when you want to load up on the right hand, and when you need to when you just maintain your table stakes, and when something's moving in your direction, you want to get the hell out of Dodge so that you can let your position actually do its work for you, rather than the gamma scalps cutting you short. So yeah, the long answer again to an even longer question, Jeremy. But yeah, there really is we could debate this for weeks on end and never come up with the quote-unquote right answer for when to effectively work those gamma scalps, delta hedges, call them what you will. And I'm glad to see you have an interesting rule set in mind. I'd be curious, once you've actually implemented, I'm sure you've done some back testing. Maybe send us some back tests, see how it works, and maybe also once you start implementing this on perhaps some real capital, let us know how that's turning out. I'd be very curious because over the years, as you might imagine, I've been contacted by people, and I've talked to people, and I've developed my own, myriad different ways to try to tackle this same problem. There's pros and cons to just about every approach out there. I'd be curious to see what your results are from this when some real rubber meets the road. But I appreciate the thoroughness of your email with the attached LinkedIn profiles and graphs and surveys and studies and everything else. Great stuff. We love all your emails, from the very short tweets to the epic treatises on all things volatility. Unfortunately, we got to keep rolling. Keep those questions coming. We love to hear from you guys via whatever platform. This was email, could be Twitter, could be live chat, could be Facebook, however you want to hit us up, or it's all baked into the mobile app as well. So we love to hear from you guys. Oh, really quickly, Mark, he did mention talking about your end of day dynamic hedging for the short options. Anything you want to add to that? Do you even remember what he was talking about?
Somebody else's presentation, and Russell and I had some conversation offline. I think there are, for a covered call strategy, I think there's some other ways to deal with it, but that's my thought process.
So that was someone else's presentation he was referring to. All right. I wanted to give you a chance to defend yourself in case you took any umbrage there. All right, let's keep on rolling then into our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball, a.k.a. The shaming portion of the program, where we all attempt to divine what the ever-fickle volatility gods hold in store for us on the week to come. 2 weeks ago, 2 episodes ago, the last time we were all gathered here together on the Volatility Views program. Let's see, we was different time frame then. Good old Mr. Corner Office, he came in around the 15.5 level. Mark was on the low side. He came in about 14 and a quarter. And I was right in the middle, about 15, and we were, I think, on the different end of that spectrum altogether, a little bit south of all of that. And then fast forward to last week when it was Andrew and myself. Andrew decided to be ever precise with his 13.01 prediction in the VIX cash. We were both feeling lower, though. I decided to go a little swing for the fences low, aka 12. That turned out to be a little bit over-optimistic to the downside, as we are hovering right around the 15.5 level right now in the VIX cash. So I know you guys both complain about having to go. So I will go first this time because I picked the lowest last time. So let's see. We're at about a 15.5 right now. We don't have, earnings season is kicking off, but not for a little while. We don't have any appreciable numbers, not like we did last week, on the horizon. That's what made last week's a bit challenging, because we just had come out of non-farms, and that's always throws a bit of a wrinkle into the volatility of forecasting. I'm going to say this is, though, perhaps a wee bit overdone. I'm going to say in the 14.5 to 15 range. How about that? So I put myself down for that. And then we shall turn now. Let's go corner office. Mr. Russell, what are you feeling for next week?
Well, you said that you know what? We got J.P. Morgan, Bank of America, and Citigroup reporting next week. Do you want to change your prediction?
No, I'll stay.
Okay,
I'm good.
And then we've got Alcoa kicking things off on Monday as well, which I'm going to say 17.
The big double A. You know, you can't wither double A, the market follows.
You know, I did a study on that I haven't updated in some time, but the Alcoa's stock reaction, it's got about a 75% win percentage telling us what the stock market's going to do over the next couple of weeks, because it's always the first one to report. So don't make fun of that little company.
Wither Alcoa. So go with the market. We need the Alcoa. We need the Alcoa single name VIX. What we need, sir. That would tell us all we need to know.
I think we do need that. You'll like this, Russell. I was on Canadian TV last Thursday, and they asked me what I thought of gold, and I said, well, if you like gold, buy Alcoa because you need a tinfoil hat.
You're going to get some angry emails off that one.
They gave a wide-eyed reaction to that joke.
So you're not going to be back in Canada anytime soon.
You do realize that 85% of investors in Canada are, shall we say, gold bugs. So you just angered the entire nation.
I know. I'll tell you what, guys. I think you're both going to be right, and then we end up here. So I think that we could see vol get to 17 earlier, and then we could actually see a 14 quarter vol on Monday, because I think we're going to rally on Monday if we end up today. I think we could see vol make a run at 17, and then from there, you could. I think we see vol settle back after some earnings come out, and we head toward maybe 15.5, right where we are now.
There we go. That's what makes a market. Russell and I taking up the wings, and Mark S., the Goldilocks there in the Chewy center. So there we go. 14.5, 17 with a nice 15.5 guts kicker there in the middle. There we have it, listeners. Send in your own predictions, your own prognostications for the week to come from a volatility perspective. But that theme music means it's time, unfortunately, for the end of the Crystal Ball segment also. For the end of this episode of Volatility Views. But before we go, one last time, let's check back in with my cohorts here on the old Volatility Views panel. See what they have cooking that may interest you. Let's start off in the land of the meatball this time. Mr. Greasiest of greasy meatballs, what's cooking in the land of the pit?
Well, Villanova won the national title on Monday. And Mark, I don't know if you remember, I went there. And so to celebrate all 35 wins that Villanova had this year, we're offering 35% all of our products, everything except for our pro course, in our entire Option Pit catalog. So you don't need to use a code. You don't need to do anything. Just go to the Option Pit site, buy something. It will be 35% off. That ends on Monday.
Can you still count yourself as an alumnus if they kick you out at the end of the sophomore year for conduct unbecoming? Is that how that works?
Well, I was only suspended, to be fair.
Okay. Well, there we go. I'm glad you clarified that, sir. Turning our attention once more to the palatial corner broom closet. Mr. Rhodes, what's cooking in the land of the Institute as well as all things at our friends CBOE Live Vol?
Rutfest! Woot! We're doing an all-day webcast series all about Russell 2000 index options, the benchmark indexes, and the volatility on Tuesday. And you can sign up for that. It's free, which is cheaper than 35% off, regardless of who won some game where people put a round ball through some sort of a hoop or something. You can find out more about that at cboe.com/seminars. Rutfest, I think it's down at the bottom of the list right now.
Are you actually calling it Rutfest? Is that the actual name?
Yeah, Rutfest. and I told the people at Footsie Russell that when I was there on Tuesday, and they rolled their eyes at me.
Yeah, I'm guessing that. I'm not sure if that would go over too well with them. I think it's hilarious. So if you're going for the hilarity factor.
Hey, we're gonna do one this summer about the international markets called International Day,
nice.
You in grade school. So I'm trying to figure out who's going to dress up as what. I think
it's going to be a Russell Fest at Rutfest.
Russell's going to be at Rutfest this time. I missed the first one. So, but International Day, I think we're going to dress Roma up as the Swiss Miss Cocoa Girl, and
I like that.
I think Peter's going to be some sort of alpine skier. We're working on all this.
Somehow I see you, Russell, in a sombrero. I just think that would be a good look for you. So you should rock that for the Mexican contingent. So check that out, Rutfest. And of course, check out our friends over there at Russell Indexes when you get a chance, as well as, of course, our friends over there at livevol.com. Kick the tires, all this fun data we pull throughout the show, implied vol, all this other fun stuff, trading data, the VIX options data, all coming from our friends over there at CBOE Live Vol. So check it out, livevol.com, when you get a chance. And on behalf of Mr. Corner Broom Closet today, and out there, Mr. Greasy Meatball, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show. And of course, for sending in such great and indeed epic questions. Keep them coming. And we'll see you next time for more Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.